Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, there's a rule of thumb that says a retiree can withdraw 4% out of their investments. People are attracted to this because it's simple and easy to understand. In reality, it can lead people to have a false sense of security because it fails to plan for the stuff that can go wrong and ultimately can be disastrous for retirees. Isn't that correct?
Yeah, that's correct, Steve. Let's walk through an example to help illustrate the point. So in the first scenario, we took the returns from the S&P 500 starting in 1989 going through 2008. Over that 20-year period, the average annual return of the S&P 500 was 8%. Pretty good, right? If you retired in 1989 with $1 million and took a withdrawal of $50,000 per year, indexed for inflation of say 2.5%, by the time you got to the year 2008, you actually had more money than you started with back in 1989, including all the withdrawals.
Now, however, though, Travis, the second scenario, we inverted the dates. And so we have the same $1 million, same 50,000 coming out, inflating it by 2.5%, same 8% rate of return.
Right.
But, and it's a big but, the S&P 500 that first year loses 39%. It's 2008.
2008. Right.
Financial crisis. Because of that, the retiree fails and they end up running out of money after just 15 years of those withdrawals. Same numbers with a much different ending to the story, isn't it?
It is, Steve, and it demonstrates the importance of sequence of return and why rules of thumbs can fall short and lead to disastrous consequences. It also highlights why having a disciplined asset allocation plan heading into retirement becomes so important. You need a strategy that balances current income needs with participating in future growth while minimizing the effects of severe market drawdowns. We've seen success helping our clients achieve these goals by using our bucket strategy.
Yeah, so let's review the bucket strategy, Travis. The bucket one is the first 1 to 2 years of income that you're going to need in retirement. It's comprised or it holds cash and money markets in it. It's built for safety and for current spending needs throughout that 1 to 2 year time frame.
Right.
And then bucket two is that 3 to 7 year time frame of income that you're going to need, where it's comprised of low duration bonds or short duration bonds, intermediate bond ladders, so you have a bond ladder, and then also real estate. Still built for safety, intermediate liquidity needs, and for emergencies such as an air conditioning unit or a furnace going bad on you. And then finally, there's dry gunpowder there to be opportunistic when you see market drawdowns.
Right. So you've got buckets 1 and 2 now with somewhere around 5 to 7 years worth of income. Why? Because that's generally how long a market cycle lasts. You've got your paycheck protected for 5 to 7 years. That allows you to move into the second part of the bucket strategy, which is the risk component. And that the first part of the risk component is bucket 3, which is your income producing bucket. In that bucket, you'll have income producing stocks, dividend paying stocks. You'll have higher yielding bonds. These assets are producing cash flow to help with current income needs and to replenish the cash you're pulling from buckets 1 and 2. Bucket 4 is going to be our growth bucket. We're going to have growth stocks in there. We're going to have emerging market stocks in there. This bucket is going to be much more volatile. The price is going to move, but you can withstand the volatility because, again, you've got buckets 1 and 2 there, knowing your income needs are met for a full market cycle. Bucket 4 can fluctuate, but over time, we can allow it to grow, and ultimately, it's going to do the heavy lifting in the portfolio in terms of growth.
You're right, Travis. This has been great. I look forward to it next week.
I look forward to it as well.
If you'd like to learn more about retirement income strategies, our contact information is below, and we look forward to hearing from you.